step out of the way. Again, thank you so much for joining us.
Hello, my name is Kelly Leonard, and welcome to this panel on trade finance, where we will discuss finding resources to go global and, more importantly, to get paid by international customers. In this session, we will discuss financial resources necessary to do business overseas. You'll also learn how companies manage financial risk that can be involved with exporting. Both private and public sector experts are on our panel today and can discuss the complexities of international business transactions and make you aware of some of the government programs that are available to support exporters. And so with that, I'd like to kick off this panel with an introduction to our panelists. Bill Houck has more than 27 years of international trade, finance, trade, credit insurance, and international corporate credit risk managed experience. He's held management positions with Export-Import Bank of the United States and private sector concerns specializing in asset-based lending, corporate credit card risk management, and global capital market originations. Bill is currently SBA's Office of International Trade Regional Manager for the Mid-Atlantic region. To his left is Yuki Fujiyama. Yuki serves as the U.S. Commerce Department's Trade Finance Specialist. In this capacity, Yuki works with commercial financial institutions to help increase access to working capital and financing for U.S. exporters, especially small and medium-sized enterprises and their foreign buyers. He also serves as a member of the Department of Commerce liaison team to the U.S. Import-Export Bank. And to his left is Federico Manno. Federico is currently a vice president and sales manager in the international group of Fulton Financial Corporation. He employs SBA and XM Bank exporting working capital guarantees and exports credit insurance to mitigate commercial and political foreign receivables risks for commercial companies. And then lastly, we have Mike Imgarten. Mike brings a unique combination of experience to his industry and owning and operating investor-owned restaurants. Living in Saudi Arabia in the 1980s, managing U.S. beef sales for 2 overseas international food distributors, and working directly for major U.S. beef packer. That combination of experience led Michael to establish United Source One in 2000, a company dedicated to marketing premium U.S. foods in the Middle East. Michael and his company are the recipients of numerous industry honor and awards, including the highly coveted Certified Angus Beef #1 Exporter of the Year. So welcome, gentlemen. Thank you. I'm going to kick off this discussion with a question to Mike. Mike, what factors relating to finance and payment are different when selling internationally compared to selling domestically?
Well, international business requires, as a rule, more cash, and I might add that a lot of the panelists and folks in this room are in all different types of industries. Being in the food business, food is almost like a currency. It takes quite a bit of money to finance food. It's a repeat type commodity. You don't sell it once and then go find another buyer. You're selling the same buyers over and over again. So it requires a lot of cash. As a rule, finance is part of your marketing package when it comes to food. Of course, every type business has to get paid, but in the food business, your finance, the way you're able to finance those shipments, the types of terms and conditions that are connected to it have a lot to do with your success. You can't really divorce the price of the steak from the terms of sale. So if I could just take one step back on that question and say, the amount of financing required in international business is much greater than a similar business in the States, where your turnover, a U.S. distribution food company will turn their inventory as much as 40 times a year, where an international it's a lot different. You might turn that inventory only 6, 7, 8 times a year. So that means it takes a lot more money to operate it. So the first thing you got to do in setting up a business for international, in our case, because we didn't do domestic business, all we started from the beginning was international, is you got to have a resource for money. And I remember back in 2000 when we first got started, I was exploring different options on ways to get money together to finance our business, and had a representative from a credit insurance company come in, and after talking with him for a while, he said, he says, Michael, you don't need credit insurance, you need a bank. And it seems obvious, but you got to have a partner, you got to have a bank. I mean, you can't be an international business without having a strong banking partner. So that set me out on the path of, okay, well, you're right, I need a bank. How do I get a bank? Well, a lot of folks will tell you, and the proverbial wisdom is, banks only loan money to people that don't need it. And we've all heard that before. In reality, banks do loan money to people that need it. And there was nobody that needed it any more than I did in 2000. We all need it to finance our businesses. But you know what? The search for a bank was an important one for me, because I was in the middle of litigation involving a former employer that didn't want me to be in business. I had no money. I was trying to cover payroll with a credit card. You've all heard these stories. Everybody's got them when you're trying to start a business. And yet we succeeded in finding a business. I had some help. I hired a person to help me find a bank, a former president of a local Baltimore bank, which was very helpful. Once we did that, once we had a bank, then you can start looking at options on how we're going to finance this. Because the bank wants to do it as a partner with you, but everybody needs some kind of protection and some facility to be able to justify being able to go to the board and get the money for you. So that's what in international, you got to have that, because there is no Dun and Bradstreet to look up, whether Faisal Nusuf and Company is creditworthy or not. You've got to, most of our businesses in the Middle East, the information is non-existent. All you've got is the ability to go there, find out about the companies, and your banker has to rely to a large degree on your own credibility and ability to collect money. So it is absolutely essential to have some kind of program in place to protect not only ourselves but our bank. So that's what we started down that road, and really it didn't take very long before we were led to the SBA. You need a amount of working capital, and the SBA, they were partners, and they certainly helped partner with us to be able to grow our business and to be able to make the payroll and to be able to tell our customers you don't have to send money in advance and have to give discounts out to get cash in the door. It allowed us a little breathing room, and over the course of 2000 through today, those relationships are what enable us and facilitate our growth. I mean, now we're a healthy company with 60 employees, lots of families, people buying cars, getting married, having babies, and a lot of it has to do with our ability to find a good, strong banking partner and take advantage of those programs that are available to be able to facilitate international business. It does take more money to run an international operation than it does domestic. I would say that.
Gotcha. And you teed us up nicely for a question to pass over to Bill, and that would be, as companies are expanding into these international markets, what programs does the SBA make available to help finance our companies?
Well, SBA has 3 loan guarantee programs. They're designed to work with a company from the very start of exporting all the way to the point where they're a mature exporter and needing to expand their operations, buy real estate, buy new equipment, refinance. A real quick question for the audience, if I may. How many companies are in the room that are a year or more old? Okay, great. A caveat about SBA is that we provide loan guarantees. We don't provide direct funding. So we guarantee Federico's loans to his customers that are using our export working capital programs. So you've got to be at least a year in business. I think most banks are going to prefer 2 or 3 years. But literally from the very first time that you start, and I guess everyone here listened to the U.S. Commercial Service and the state of Maryland talk about their services, but from the day that you start speaking to those individuals about going overseas, you can use our programs. The Export Express Loan Guarantee Program can be used for any export-related activity. So you're speaking with the state or you're speaking with Bill Burwell's staff about going on a trade winds mission or going overseas to meet a buyer that they're introducing you to. You can fund that entire trip. You can fund the Gold Key service. You can fund access to a lawyer in country. You can change your website into different languages. All the things that are necessary for you to get overseas and close a deal, you can use that program. Once you start actually acquiring orders, once you're actually booking orders, you can finance those orders under our under that program. I won't get into the weeds, and I'll be around to talk more detail about how these actually work and how all the different types of transactions that we can fund under those programs. But for most of the people in the room that are really here to look at what opportunities are overseas and make exporting a part of their business, that Export Express program is something you really want to understand. Once a company, very much like Mike's, once exporting is a critical part of a business, you're going to experience some pretty rapid growth. I think, Mike, you confirmed to me that once exporting was really part of their business model, they were experiencing anywhere from 5 to 20% sales growth. Obviously, then working capital is going to become very important. So our Export Working Capital Guarantee Program, which goes up to $5 million, that's used for that regular ongoing service of orders, or it can be used for one-off purchase order type of financing. Then you would graduate into, and I'm hoping that Mike will be looking at these over the course of the next few years, our International Trade Loan Program. That program's used for financing fixed assets and real estate. So let's say they're to the point now where they've grown, they're at 100% capacity. They need more forklifts. They need another 100,000 square foot of warehouse space. They could use our International Trade Loan Program to finance that type of activity, to finance that growth. So of all three programs, from the time that you start to the time that you're a 10-year-old exporter, those programs can help you out. And I'm sure Federico will talk about how he goes about using it.
Awesome, thank you. Now, Yuki, I'd like to throw a question your way. I'd imagine there's this challenge when you think about lending, and there may be a reluctance to lend particularly large sums of money to organizations that are in developing countries for extended periods of time. Are there any government programs that are available to help exports meet these challenges?
I think one of the viable solutions to those challenges is the foreign buyer financing offered by U.S. Export-Import Bank, also known as Exim Bank. As the U.S. government export credit agency, Exim Bank supports the purchases of U.S. goods and services by credit-worthy foreign buyers who are unable to obtain the financing they need through the traditional commercial sources. Exim Bank does not compete with the private sector, but they provide financing for the transaction that would otherwise not take place because commercial lenders are either unable or unwilling to accept the country or commercial risk inherent in the deal. So in other words, with Exim Bank foreign buyer financing, U.S. exporter can turn their business opportunity into actual transaction, and the exporter can get paid cash on delivery and acceptance of the goods and the services. Let me give you an action example. Last year, Exim Bank provided financing for the Chinese company for the purchase of the agriculture equipment valued at like $22 million from the U.S. exporter based in Virginia. Exim Bank support was needed because long-term commercial financing is not readily available to any entity in China. Let me say this another way. So the Chinese buyer couldn't get any financing from commercial sources. And the US exporter was not in a position to finance these export transactions. So Exim Bank basically stepped in and helped to turn this export opportunity into actual transaction by guaranteeing repayment of a long-term commercial loan extended from a US bank to the Chinese buyer. So let me explain this in a little bit more detail. So the US exporter sent those 22 million worth of equipment to the Chinese buyer. Okay, Chinese buyer got those shipment. At that time, US exporter was paid by the bank. Okay, then Chinese buyer start using those equipment for their farming operations, start generating money. Then, should the Chinese buyer default on the payment, okay, what will happen? US exporter is already got paid out of the picture. But Exim Bank can pay the money to the bank. Then Exim Bank can go after the Chinese buyer to collect the debt. Do you see the concept? So basically what Exim Bank did was made everybody in this deal comfortable going forward with the transactions. So generally Exim Bank can assist the US exporter and their foreign buyer by providing guaranteeing on the commercial loan. And certain instance, but Exim can also provide a direct loan to the credit-worthy foreign buyer if necessary. Okay.
Awesome. So Federico, question your way. One very important question in any export transaction is determining how to get paid. And so what are the different options and risks that are involved in getting paid? And then what role does export credit insurance play in managing or mitigating some of that risk?
Sure. First of all, thank you, Kelly, for inviting me today and the group over here. By the way, one thing I want to clarify, I work for Fulton Bank, but in Maryland we own a bank called the Columbia Bank. And so in that respect, we work under the Columbia Bank in the state of Maryland. In terms of payments, obviously you export. I know Mike just mentioned about a cash in advance, which is of course it's a payment option for an exporter. And obviously, if you are an exporter that starting to export, or you've been 1 year into the business, or you don't know your buyer too well, that would be an option. But as my friend Mike here said over here, it's kind of limits you in many ways to do business, because obviously you got to provide discounts, so your profit margins become minimal, dismal, if you will. And so cash in advance is fine. Also, cash in advance can be used for smaller type of transactions, $10,000, $5,000, $15,000. That's something that it's doable. As the transactions become larger, in hundreds of dollars, obviously you're looking at different payment options or different methods of payments. One of them, and of course, cash in advance is the lowest risk, because you get your money up front, you're done as an exporter. You just have to deliver on the contract. The second, right below that, is what we call letter of credit. Sometimes it's called irrevocable letter of credit. Sometimes it's called trade letter of credit or commercial letter of credit. There are different varieties. And it would be like an export transaction or export letter of credit transaction. It has different kind of payment terms. It can be a site, it can be deferred payments, and I'm not going into details right now because we can spend like 3 days reviewing that kind of terminology. But in reality, it's probably the second safest payment for an exporter, because obviously at that point, what you're doing, you are replacing, if you will, the credit worthiness of your buyer overseas in Kuwait. Just throwing a name there, India, whatever it may be. You're replacing the credit worthiness of that buyer that you're selling to with the credit worthiness of the bank. Okay, so the bank in India, in Kuwait, will issue that commercial letter of credit, and that will be received by a U.S. bank, hopefully Fulton Bank, who will be your advising bank. In some cases, could be a confirming bank, and essentially LCs fall into two categories: confirmed and unconfirmed. And then we will negotiate the payment under that letter of credit. And obviously, a letter of credit has pretty much the standard documentation that you need to have. Michael said earlier about bank. You got to have a bank to finance your exports. You got to be into a marriage with that partner, if you will. The second marriage you got to be into it as you export overseas is with your freight forwarder. Okay, your shipping company, freight forwarder, because the logistics company, because that's the company that's going to essentially pick up that container, from your shop, from your warehouse, and take that into the port of Baltimore, or whatever it may be, or BWI if it's air freight shipment, and go out to destination where the end user is overseas. And so you got to have shipping documents under letters of credit. And what they are, the normal stuff, the normal documentation, normal legal documentation, commercial invoices, packing lists, ocean bills of lading, airway bills of lading, insurance certificates, inspection, and so forth. Then the third payment below that, it is what we call a documentary collection. But then you've done so much business with your overseas buyer that you already know. You got paid in advance, you went through letters of credit, now you're going through collections. Collections essentially does not provide the same kind of payment guarantee of a letter of credit, but it's pretty close to that, especially after you've been doing business for a while with them, with your buyers. And essentially there's a flow of documents between banks, but there is no release of goods, okay, unless payments are made only after the overseas buyer cashes the money for the transaction, releases the documents to the buyer, the title documents that I just described to you, and then the payment is sent over via SWIFT. I think you guys are probably familiar with SWIFT. I don't have to go into more details on that. Essentially, it's a well-known, recognized, electronic, authenticated payment made by overseas banks into the U.S. market, into the U.S. money center banks. But then, of course, you have the open account, which is the most interesting. Essentially, the open account is the fourth type of payment. And the open account, and now it doesn't really have to be through these three methods I just mentioned to you. It could be a point where you just do one export letter of credit. You say, these are a little too complicated for me. I don't have the resources in-house like Mike does, because Mike has got 60 people there. He's got people that have been negotiating letters of credit for years and years and years. And in fact, Michael may have examples there where you have started with letters of credit and then you switched over to open account. I'm sure you may have situations like that over the years that you have experienced. Absolutely. Yeah. And so you go open account. Essentially, is your net 30-day payment terms that you normally do against the domestic AR or accounts receivable. That obviously it's doable. You got to do a little bit more work. You got to essentially investigate the credit risk of the company overseas. Maybe DNB. You guys are familiar with DNB? Is Dun and Bradstreet. They have like an international section, or they call DNB International, where you can get some credit reporting on some companies, some buyers overseas, some foreign buyers overseas. If not doable, Euler, COFAS. They have very extensive, if you will, credit bureaus and offices overseas. COFAS was the first, for instance, if you're selling to Russia, COFAS was the first commercial insurance credit office ever open an office in Russia and Moscow. By the way, having said that, they have a lot of knowledge of companies, so they can give you like a credit report to see if they pay on time and so forth. And so you've done an investigation. You said, maybe I'm maybe interested in doing some open account transactions selling overseas. Obviously, if you sell overseas, you're talking about you are specifically looking at a foreign risk, or what we call sovereign risk. And it falls into a different type of risk category because obviously the company is overseas. At that point, what you could do in order to secure, in order to make sure that there is not a default on your payment, you could look at an export credit insurance policy. And an export credit insurance policy works two ways. Number one, of course, it works in the way that if you are not getting paid based on the terms of your contract, net 30, net 45, net 60, whatever payment terms you have. Then obviously, when the clock runs out, 90 days, that's normally 90 days is the magic number. 90 day, usually the receivable is no longer, or the foreign AR, foreign account receivable, is no longer eligible at that point for financing. And so at that point, then the exporter can go out to Colfax, could go out to Euler, could go out to Exim Bank, because Exim Bank also offers what they call Exim Bank credit insurance policy for small exporters or for larger exporters. They have all kinds of packages in there. And that's a good insurance. We use it constantly. And then claim their money, start the process of claiming that defaulting AR that you're dealing with. You may be able to negotiate that with your buyer overseas, so there is no need then to claim, or maybe you stop your claim at that point if you collect it. But more importantly, the second reason why you use the export credit insurance policy is because, as I explained to you, as I mentioned earlier, being a sovereign risk or a foreign risk or a foreign country risk, normally you will not find U.S. commercial banks that will lend money against foreign AR because of the particular reason. There may be exceptions here and there, if we're dealing with a customer that's extremely liquid and has got a lot of money and we got more collateral out there pledged to the bank than the actual amount of the line of credit or receivable. That could be some options that we can look at it. But normally speaking, that receivable, what happens, it is pledged, if you will, endorsed the coverage to the bank. And the bank receives that pledge, and then we become the lost payee on the coverage. And so at that point, we have the comfort zone, or what we call in banking the credit enhancement, that will then put together a line of credit, a working capital line of credit, because what we're working with short-term. That's what we're short-term working capital lines of credit. In other words, you borrow the money, you buy inventory, you generate a receivable, you sell, you collect, you pay down the line. Working capital. It's constantly working. Turnover. You just heard from Mike earlier talking about turnover, 6-8 times a year, okay? So that's what a working capital line of credit is. So with that pledge, with that endorsement, with that enhancement, then banks feel comfortable in lending money, in establishing lines of credit that can be used for financing your receivables, for financing your export sales overseas. That's pretty much in a nutshell. The last one I would like to mention to you, it is consignment. We talked about cash in advance as one method of payment. We talked about letters of credit. We talked about documentary collections. We talked about open account. Consignment is the last method of payment in that chart, if you will, in that spectrum of risk. And consignment, essentially, it is the highest risk, the highest risk for the exporter. That means essentially you ship the merchandise out of the country, the container, the pallet, but you are at the mercy of the buyer to make sure he sells the goods, make sure he collects those receivables, and he pays you because you sent it on consignment. You're waiting for them to pay you. That I would not recommend it to anybody. Okay, unless maybe you're thinking about sending some kind of samples overseas, some marketing material, some demos, a couple of $1,000s a year that you can afford it. You send it on consignment just for demonstration purposes. I've seen some companies doing that, maybe on the larger scheme of things. That is a possibility to do. That would be the closest thing to consignment that I can think of. But normally, when you look at those 4 payments, 4 options that I mentioned to you would be the safest way to go with.
Now, Bill, one of the things that Federico mentioned was working capital loans. What parts of an export business can benefit from working capital loans backed by SBA?
Well, going back to what I said before, really working capital just to fly overseas. Many times companies are stretched both on personnel and their cash position. So they don't have to worry about burning up their own cash on their balance sheet to aggressively go after exporting. They can use the Export Express program to do that. Kind of summarizing what we've all been talking about here is, I don't know how much more time we have, but it's really critical for companies to build finance and credit into your sales approach. You need to understand when you can offer open account terms. You need to understand that you've got available working capital to service a transaction that might be larger than you typically service. So before you start looking at overseas opportunities, understand all the tools that are available to you so that you can shorten that sales cycle. That you know before you go overseas and talk to a buyer, you've talked to Federico or another lender about qualifying you under one of these programs so that you've got access to capital so you can adequately plan your sales campaign overseas and having available working capital. So let's say your average sale is $20,000. You're in Colombia and they surprise you because of shipping and economies of scale. We'd really like to order 100,000 from you. You know that you're not going to be hemming and hawing at that time because how am I going to service a $100,000 order? You know that you've got the working capital. Let's say you decide that that 100,000, that's fine, but we'd really like to think about cash in advance or letter of credit. Be prepared to provide different pricing options based on those terms of sale. So you need to have all these things, all this knowledge, access to capital, access to credit insurance. This should be all done well in advance to negotiating your sales. And I think Mike can speak to that. I mean, having that comfort level that he can service pretty much any size order that's reasonable because he knows he's got Fulton Bank there to help him discount those receivables. And we also talked about the medium term, where let's say that he decides to add processing as part of his business model. So he's actually going to set up a processing plant in Saudi Arabia to produce some type of packed meat product. As Yuki had mentioned, he could then go to Exim Bank and use medium-term financing. So having a good, strong knowledge of all these things well in advance can really help you shorten the sales cycle and close deals a lot quicker with a lot more confidence.
And one of the things that Federico sort of touched on in terms of what he was sharing in terms of getting paid, he mentioned something about like default or traditional non-payment, but then there's also the risk of just operating inside of a foreign currency. And so one of the things that I would love for you to share, Mike, is sort of how do companies approach the challenge of working in other currencies, and then what are some of the strategies that you can use to manage that foreign exchange risk?
Well, we like U.S. dollars, actually. We like dollars because it's an international currency, thank goodness. So that question may not be best directed to me, but if I could just comment for a second on and then pass that over to Federico. In terms of what the rest of the panel's been talking about, as an exporter, as someone who's shipping outside the country, you really do need to understand, cannot emphasize enough, the importance of understanding the tools that you've got in terms of finance. When I was at worked as an employee at a major company that was dealing in, they were hedging currencies and things to do all kinds of billion-dollar transactions. But us, we were trying to export beef. And the credit manager would just, I don't want to sell there, tell them to send cash. And it just doesn't work. Just because you're a big company doesn't mean you can dictate terms like that. In an international environment that we operate in, the financing and the ability to understand your customers' needs and the risk is just as important as the price of the product. They're absolutely just as important. So be sure and understand those tools. As Federico said, first you got cash in advance. What we always do when we go, we don't know the customer very well. Yeah, there's DMB and there's ways to research it. But at the end of the day, first transaction, you want to be able to persuade that customer to send you cash on the first one. Second one, maybe half down, half of it on a cash against documents, document collection basis, where the documents go to the bank holds the documents until such time that the goods arrive on a container, and then the customer goes to his bank and exchanges cash against document. He gives the bank cash, which goes to you. He gets the documents to clear the container. Everybody gets paid. That's a very good way. Letters of credit are usually great as long as the customer's got the ability to get a letter of credit open in a bank. They're messy, they're exact, they're precise. I'm a sales guy. I don't like precise and exact. That's why you need good freight forwarders and people that do that sort of thing. But you know, the thing with the letter of credit's got to be very precise. You can't make any mistakes, and there's always a mistake in a letter of credit. But that's another way to that's kind of a shotgun approach of financing. If you can do a letter of credit with somebody and the guy says, well, can I get 90-day financing? Well, I haven't got the money for 90 days, but if you did a 90-day letter of credit, well, maybe the bank will do that, and maybe you can cash that LC out cash it out for a discount once the goods are shipped. So there's all different sorts of, you need to have those tools at your disposal when you go to sell. So you don't have to tell the customer, just send me cash in US dollars. And in terms of foreign currencies, I'll defer to Federico on that.
Yeah, thank you, Mike. I'm glad you explain. You mentioned more on the. You gave more details on the payment tools as well, which is very important. Yeah, as far as the foreign exchange, Mike is right. I mean, when you're looking at the dollar, the green buck is just or the greenback is essentially the largest world reserve currency at about 56-57%. In the world. So I mean, it's still, we used to be at about 70 plus. There've been other currencies that have come in. The euro is one of them. The euro is essentially the alternative to the dollar. And now we've seen, we've seen also the renminbi, the Chinese renminbi, that is picking up tremendously because they go into countries and they do bilateral swap agreement with Brazil, UK, and just swap the trade in the exchange pounds versus renminbi or Brazilian reals versus renminbi and so forth. So we've seen a lot of these bilateral agreements. Nevertheless, for you exporters that have been in the market for, let's say, a year, 2 years, I would stick with dollars. However, as you expand your horizons and as you expand into different countries, sometimes it will be interesting for you to ask your overseas buyers if they would like to have quotations in a foreign currency, because that would essentially what it would mean. It would mean that you may be able to win the business if you were to quote in the particular foreign currency, because if you quote in that US dollar, the competition may win versus you, and so that's something you need to be aware of. The other thing I will also suggest is that as you become savvy on the foreign exchange side of the business, is that if you see that the dollar is appreciating versus the euro, so it's not today the euro is trading at about 1.38, but you see all of a sudden there is some kind of crisis and the dollar is getting more valuable and it's going down to 1.32, and you got to make some payments out there, in euro. Well, go out and buy yourself a block of money in euro and park it, because at some point you're gonna have to make the payments. So that's what the hedging is all about. We do a lot of hedging in that part of the transaction of the business. Other than that, yes, I mean, foreign currency, you can buy it in spot, or you can buy it as a forward contract, and it's up to 12 months. So you're going to hedge your risk, the possible fluctuation that the dollar may be running against you at a 12-month, interval out there. And so in that respect, that's when the hedging comes in as a way to protect yourself against fluctuation that may occur.
Do we have any questions from the audience? Please take the stand.
Martin Lewin, hello. Hi, Federico. I actually have two questions, and they tie together in a certain way, and it deals with credit worthiness in both cases. Mike, to you, you set forth your scenario for starting your business, and I heard about SBA. You started off, though, with your own business, which was a new business, if I understood correctly, and you were in litigation. Okay. And then I heard from Bill that you need to be in business for a year before you can connect with SBA. So I want to hear you talk about that. Yuki, I have a question for you.
Sure.
You talked about a company which had an equipment sale to a Chinese company in the amount of $22 million.
Yes.
My experience with Chinese companies has been that they don't have 3 years of Western financials. And that seems to be the sine qua non before Exim will recognize you as a credit-worthy customer. So I'm curious as to what type of customer was involved in that. So you can address.
Let me answer your question.
Please.
Okay, the company was talking about was actually a Chinese government procurement company. Okay, so it's part of Chinese government, and there was also a Chinese government agency involved. The Export-Import Bank of China was part of the deal too. So that made feel like an Exim Bank a little more comfortable.
Yes. Yeah, and sometimes also in those particular situations, if it is like a government ministry in China, obviously not only the fact that they may be able to issue letters of credit as well. Sometimes the LC can be issued in favor of, let's say, either the exporter or a sign from the exporter to Exim Bank as a collateral tool to essentially, protect themselves and then extend the loan. Yeah. Or what we call bank guarantees. In the U.S., we cannot call them bank guarantees because of the law that was back in the 20s and 30s. We can only call letters of credit or letter of credit instruments. But overseas, the bank guarantee concept is still there, and that's what they will be looking for, a bank guarantee.
So the typical sale of small and medium-sized company to small and medium-sized company into China is somewhat difficult.
It's very challenging.
Thank you.
Yes, my example was a very oversimplified example. Okay.
Thank you very much.
And then Mike and Bill, do you want to touch on his?
I'm very curious about how you started, which is really very interesting.
Cash in advance.
Companies are in that.
Well, they did it with cash, but- and I'll be frank, I don't recall exactly if that 1 year rule existed back then, but I did have my own company that was established, and in setting up the new company, there was a bank of business that was there that got rolled into my company. So, yeah, I'll tell you what, the SBA and the SBA in particular was proactive in finding a way to do the deal. They weren't, you might perceive government agencies, and I've dealt with a lot of them in dealing with food and USDA, not to mention one specifically, that make it very difficult, okay? But SBA is not like that. They worked to facilitate the deal, and that is an important distinction, I think. And Bill might be able to add a little bit more.
Yeah, I mean, the critical point is that you're dealing with management with years of experience in the industry. They had a chunk of an existing business that they were bringing to the plate. They had operating history. The management did. So SBA will consider a company less than a year old if the ownership management has significant experience in the industry and it's sufficiently capitalized, and if they've got credible transactions to finance. Those, that's not the easiest formula to come up with, but there are exceptions.
Thank you.
Last question.
Bill, you just answered the question that I had with respect to criteria for getting a loan if you're a startup. So I guess that's some of the criteria that you just mentioned.
Right. I mean, for Federico, for Fulton Bank, they're going to see your ability to repay, and if you've demonstrated in the past that your ability to perform, you've put adequate capital of your own into the business, and you've got transactions and other assets to collateralize the loan, then they very well may consider you if you're less than a year old.
Yeah, if it is a brand new company where there's no track record, it would be very difficult for any commercial bank to lend money However, if it's been in the business for like a year or maybe shortly less than 1 year, you've seen some track record, performance, sales, like a working, in progress transactions. Also, like what Bill said, if some of the principals, partners, because normally when you lend money, you need to have you need to pledge personal guarantees. The borrowers, the companies need to pledge. The principals of the companies need to pledge personal guarantees. So if you're looking at some partners that are pretty strong and they've done some other business, they got business experience and so forth, those waivers can take place, and therefore, yes, we will be able to break a little bit of the rule, if you will, tweak it in some ways. Yeah, but it has to be a combination, a blend, a bundle of things. Yeah.
And I just had one other question for Bill. Does the SBA have export programs to export books?
Anything. Services, goods or services, the program will support export pretty much of anything.
And also military equipment. Defense-related equipment, the SBA will support that. Exim Bank will not. Okay?
Thank you.
And I can add one point to that might be helpful as a new business, because we were in a unique situation when we started. The bank and the SBA together with us were very, very helpful in finding solutions. They want to do business, we want to do business. So one of the ways we were able to accomplish that in terms of financing was we had a very good friendly customer that was willing to open up a standby letter of credit for $1 million, assignable to the bank. So in the event of some kind of non-payment or default on our side, they could draw against that standby letter of credit. A very creative solution, but again, you need a good bank that can help work through these kind of problems. Every situation with a business is going to be different, every one. There are hard and fast rules, but then there's lots of ways to work with your bank and the SBA and Exim to find solutions.
Awesome. Well, thank you, gentlemen. This concludes the panel on trade finance. Bill, Yuki, Federico, Mike, thank you so much for your time and expertise.
Thank you.